Yay. All right. Let's get the show on the road. It's 10 o'clock. It's February 14th. Happy Valentine's Day, Springer Realty Group. And today's a is going to be a fun topic. I think it's a fun topic. We've been talking a lot on our locker room coaching sessions lately about working with buyers and different strategies. And I think this is a very timely topic. Um, we're excited to welcome Micah Jones and Diane Malley from Foxtrot Mortgage. This is not actually a Foxtrot commercial today. This is actually some really interesting, in my opinion, content around the benefits of these are the topics, right? We're going to talk about locking rates instead of floating rates. We're going to talk buying versus renting conversations and why maybe now might be just the best time to buy a home, regardless of when rates are. And so this is really Micah and Diane's show to lead, but I'm super appreciative of their time. I think all of us are. So thank you guys so much. Happy Wednesday. Happy Valentine's Day. And the show is yours.
All right, thank you. It's good to be here. Hello, everyone that's just joining. We wanted to just get on here and just talk about those kinds of things. Maybe it will help you with some of your buyers or your sellers that are sitting on the fence waiting to go, why it's better to do everything now. It's always better to do it now than wait for a rate or wait for this or wait for that. So Mike is going to kick it off. He's going to share his screen here. There we go.
Yeah, can everybody see that?
Yep.
Okay, good. Okay. So as a lot of you guys have noticed, with just receiving the weekly rate sheet that we've been sending out, rates prior to this were hovering around, prior to this week, we're hovering around 6.625 for the past month, basically. And we recently had an inflation report that came out that was higher than expected, and that drove interest rates up. So if you see approvals coming out that show, 7.125, 7.7 and a quarter for your buyers, and you're like, whoa, well, what happened? That's kind of what happened. The inflation report was at 3.1, which was higher than expected and higher than they wanted to see in the last round of economic data that just came out. So that is why they've spiked, and this gets a little confusing because we heard at the beginning of the year that the Fed's gonna has announced three rate drops in 2024, and that now it's kind of like mixed signaling from them because now we see the interest rates coming up. But just that it's always good to remember there's so many factors that impact interest rates, like the Fed's interest rate and how they impact it has a strong impact, but it's not the only thing that has impacts on interest rates. So that's kind of why we're seeing higher rates today versus last week. They were at 6.625. So sometimes you'll see big jumps like this because of economic data, but then it tends to settle kind of back out. So I don't think we'll see these stick around for too much longer, especially as more of the jobs reports come out. If they're lower, that can have an impact. So there's a lot that can change interest rates. It's not just the Fed's announcements, although that does have a strong tie to them. Inflation is really what mortgage rates are tied to. So if we see higher inflation than the Fed wants to see, we're going to see higher rates. So that's the situation. So just an update there for you. Yeah.
Hopefully by Friday, when we send out the rates again, we might see a little bit of a decrease in there. Even if it's an eighth of a point, it matters. We like to try to see the 6 be the first number right now. So we do our best to get it to 699. The good thing for Foxtrot is we are beating a lot of our competitors. So we kind of had that ability. So the second look is still super important for us to get a chance at that because we're not the only company affected by it. Everybody's affected. So everybody's rates have gone up. So we're still going to beat the rates that are out there 99% of the time.
Yep. Okay. And then next here we have rent versus own, and we kind of did like a we did Pennsylvania. It's really hard to get specific data to specific like Southwest PA or whatever. So I just stuck with like Pennsylvania as a whole because that's kind of the market. Obviously, that's skewed a little bit by like Pittsburgh and Central PA, but it's just helpful to kind of give you an idea of like what home prices look like in our state. So this is the average home price. So down here below, Pennsylvania home values 254. The reason that's important is because when we were doing these rent to own comparisons, it's important to like compare apples to apples as far as like what someone could rent and what someone could buy. So I believe this is a 3-bedroom, 2-bath property. And this is average again for Pennsylvania. It's not like specific to our region, but it's helpful because it's going to track pretty similarly. But so we have $1,795 for a 3-bedroom apartment or home. I think it was a home in Pennsylvania, and then the average home price is 254. And then we come over here, which is the monthly payment, and looking at the home value, we did 5% down because that's what most like first time home buyers usually have to put down. Included mortgage insurance. The mortgage insurance might be a little high for that price point, but might as well be conservative. So you look at the total monthly payment is $2,081. This isn't as flashy as like what it used to be like when interest rates were lower, where it was like the decision to buy versus rent was so clear because it was a lower payment. But what we have to like focus on as salespeople, I think, in our markets is like if people are renting and you're trying to convert them into buyers, it's good to really stress the fact that they're going to be contributing to equity, because at the end of 30 years paying 2081 versus maybe 13 what was it, 1795,
yeah.
which is a little less than $300 difference. Like they're going to have 254 at minimum, and in 30 years they'll probably have 500,000 in equity because appreciation. So I think like that's the one thing, like I've seen it a lot on Facebook, and I think it's kind of clever, but it's also very true that like when you're renting, you're paying 100% interest because you never get anything back from that. And so it's really important. And you don't get anything back. Plus, you can't put a hole in the wall to hang a picture maybe and stuff like that. So there's a lot of, it's not just you're paying a little bit less. You're also not allowed to do a lot of stuff when you're renting. And that can feel constricting to people. So like a lot of those things are, and you also have to deal with a landlord, whether or not they get back to you on time, like that $300 difference, unless they have a perfect situation as a renter, which is what I've come to find is very rare. Also, you could get asked to leave at a moment's notice. All those things like are really important to consider, and $300 different for a similarly, let's say it's a similarly sized house to your like maybe apartment or the house you're renting. It's not going to seem as high, like if you focus in on like the fact that you're gaining equity and you are free to do what you want with the house, and all that
Nobody
comes
can take
along
it
with
away.
being a homeowner. What's that?
So with that said, there's a great example that we just had, and I like the story that goes along with that. So we had a woman, she was 40 years old. This just closed last month. 40 years old. She never bought a house. She was very scared. She was very poor growing up. So my realtor brought me this woman, and we started talking, and I saw her fear of home ownership. She didn't think she could do it. When I got into her application with her husband, they made over $200,000 a year, and they were renting. Okay. So I had, not only I've been doing this for 24 years. I love first-time home buyers and opening their eyes to what can be. So we went through the scenario and she's like, I don't think we can do it. It's more money than what I'm renting. I'm renting the same house down the street from it. I said all the things that Micah just said. I said, but you're not growing in equity. And one of the things, you're paying your equity down, but the real estate market goes up on an average of 4 to 5% each year. So if she had bought that same house, we went back and looked up what that house that she was purchasing on the street she was renting on, she would have bought it for, I think it was 125. She was now paying two something. She would have had over 100,000 in equity just from the market going up. Not to mention that she would have already paid down that 125 or whatever it was further and further. She would have been in such a good position, something that she couldn't do by just saving money. Typically. I mean, obviously, if you're in a good investment, you can, but that goes up and down. Real estate is pretty steadily up. And so she realized that opened her eyes when I said, look at, if you bought just 10 years ago at 30 years old, this is what you would have had. And she was just like blown away. I said, now is the time. Don't look back. You can't change the past. Buy this house. It's going to be a great investment for you. It's going to give you the security. That's the other thing. People like security. She was afraid because she had been, when she was poor growing up, her parents had to go from property to property whenever they couldn't afford this rent anymore, or the landlord decided to kick them out. So it's just always that conversation of like, look, you're paying somebody else's mortgage off. Why don't you pay your own mortgage off? It's part of your portfolio of your investments. When she started to wrap her head around that and what her debt to income ratios were, I said, you could probably afford way more than this house. They had zero debt. She was adverse to debt. This is her best debt. Don't forget that. This is a great conversation of, why is your mortgage your best debt? Because it's a write-off on your taxes. And that is helping you get money back at the end of the year. All these years of her and her husband making $200,000 with only they had one child. So they were getting a little bit of relief tax-wise from their child, but this house was going to be better than that for them. So the money she was getting back and all of that, when we did all of these math equations, owning the home was cheaper for her than renting and a better investment. So that's the kind of conversations you want to have with your buyers and sellers. We can get in, we'll get into a seller one later on. We have a great clip of one of the market leaders that you guys can watch this little clip. But we thought this was perfect. So it's never wait for the right interest rate, wait for the right home price. Buy, if that's the value now, buy now. It's only going to get better.
Yeah, and I think this is becoming more and more of a common conversation these days, because a lot of people, like I just had somebody that was looking and they decided to rent because they had a family friend that was giving them $1,300, and their mortgage payment on the house they were looking at would have been $1,600, which for that particular market, the $1,300 is a great deal. But still, it's like the longer you wait, the like prices will go up, and they always do. And plus, like when interest rates drop too, everybody thinks that's the perfect time. But really, like as we've seen the past 2 years, like that is when there is most competition, and it becomes a lot harder to even get in a house. And if you do get in a house, you're probably paying more for it than you would have hoped anyways. So like I think it's a really good thing to stress, especially right now as like interest rates are on the higher, like they remain a little bit higher. Especially with this last bump, is just to encourage people like now's the time to find a home with less competition, and then when it comes time for rates to drop, they can always refinance. So like that's like a huge it's just what like buyers are thinking right now. It's like, well, I should just rent because it's like I'm gonna save all this money, when in reality it's like if they keep waiting, they're going to run into higher prices and more competition, and it's just not always what they think it is, and so that's why we need to be like kind of really in front of them, educating and making sure they understand, what they give up, and like when they rent, and what they gain from being a buyer of a house and a homeowner. So,
Yeah.
yeah, that's just like
Let's open it up. Does
another
anyone have
thing
any?
to remember. Yeah, go ahead.
Stu, did you have a question?
Well, not a question, more of an observation. So just so everyone knows, just from a brokerage standpoint, we had over 200 rental transactions last year. So there's a lot of agents doing a lot of rental deals, and I'm really curious to maybe the folks on the team, um, like kind of like Diane, what you just shared a great story, an anecdotal story, and I'm wondering if anyone else has anything that what do you bump up against? I mean, you guys are working with a ton of renters out there. How do these
Yeah.
conversations go? Maybe it's helpful just to hear just real talk. How do these go? Do you have these conversations? I'm curious.
Yeah, I'm curious about that too.
Well, for myself, I've always been pro purchasing a home versus renting. I look at rent, and I've read enough books. I read books every day on, wealth creation and so on. But I've read enough books where it does clearly say renting is like a wealth. It just, there's no way you can even accumulate any wealth whatsoever. It's like a wealth buster. But my question to you is, or is there any first-time home, buyer credits or incentives going on with the government?
Yeah, we'll Sharon, thanks for sharing that.
Mhm.
We'll get that. Um,
On slide
we'll
4,
cover
we
that
have
on the
like
last slide.
Okay.
products.
Yeah.
Yeah, that's coming up. We only have 4 slides here.
Mhm.
We just wanted to kind of overview all this. Micah, let's
Mhm.
skip over to the next one.
Okay. Let's see if I can. Hold on. Okay. Okay. Do we want to go to the first time home buyer one, or do we want to
I
cover this first?
just stay the course on this one, and then we're going to
Okay.
get to that because I think that's an exciting topic too, Sharon, is all the first time home buyers and what's out there and what we do on a daily basis. Micah and I work with a lot of first time home buyers,
Uh-huh.
and later you'll see why too. Go ahead, Micah. This
Um,
one here is, whether you should. So this is a big question that we get asked every day, and I'm sure you guys get asked this too. And we want you to have some knowledge around this. Should they lock or should they float? Micah and I cringe when we get a buyer that wants to say we want to float the market because we know what the market is today. Imagine if somebody came and now they heard that the rates are going to drop this year. And now we just had an increase 2 or 3 or 4 days in a row where we lost in the market. The rates are higher and higher and higher over the last few days. And from 6.625 to 7 1/8, that's a big jump in a short period of time. That same buyer that I just told you about a few minutes ago, that was afraid to buy, when she locked, this was a while back, she locked at 7.875, and that was a good rate at that time. When we closed her at 6.99. The rates had dropped almost 1 full point for her, which is unusual in the 24 years that I've been in business. They have not drastically changed that much in a 30 or 45 day lock. Okay. But our favorite phone call, Micah and I, our favorite phone call is to call the people and say, hey, guess what? We got you a better rate because we're going to float that rate down if they go. She was thrilled that she was not locked into, she was locked in. So if the rates went up to 8.5, she would have loved us as well. But we also were able to get her a one-time float down. We can do that with everything but jumbos. Okay. Jumbo is tricky. They don't really do it. Now we have ways that we don't like to advertise where we can pull it from one investor and give it to another. That makes you an unpopular broker to these investors. So we try not to do it. But are we going to let our client go to the table unhappy with what they have? Absolutely not. We're going to always do our best to make sure they're getting the current market rate when we go to closing. So we don't want to hear that they don't want to lock. We don't force them. It is their decision, but we're going to have that conversation. And if you're having that same conversation, it could be very helpful just to say, look, you get a one-time float down, or talk to your lender. don't maybe promise that, because it depends on their product. Like if they're in some of these first-time home buyer programs, we're going to talk about that, Sharon, they may not be able to float down. So those are locked, and that's what you're in, because these grants come with, they control the rates, not us. So make sure they're talking, whether it's us that's the lender, which we hope it is, we're going to guide them through this lock or float. And again, I like to tell a little story. So we had a very difficult buyer. She was too busy to pay attention, a lot going on in her life. She told us she wanted to float. She told us in an email, she told us over the phone. We kept telling her, look, you should lock, you should lock, you should lock, you should lock. I called her probably every 3 or 4 days in the transaction to see if she would lock. She said, no, 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 no. Luckily, we had it in writing. We had it in some text messages. And by the time she started paying attention to this deal, she was mad at us because we hadn't locked her, because she lost in the market. Now, I had the proof of her not wanting to, had to remind her gently, of course. And then she's like, well, you should have told me, all of this stuff. And I went back, luckily in writing with text messages, begging her to lock. She wouldn't lock. She ended up locking when we had to lock her, and she had to take that day's rates because she waited until 5 days before the thing. And I forget, Micah, can you know who I'm talking about, right, Lisa?
Yeah.
Did she end up with a better rate? No, I don't think so.
No,
right?
it was like she ended up having to pay like a certain amount of points for the rate that she initially would have gotten for 0.
Yeah. So
was
it's
like a
never,
point or two.
yeah. And in our opinion, first of all, I don't like to see them pay points because they're going to have a refi, and refi costs money. So we want to have that conversation. We have that in detail, and people are very happy for it. That you're going to come across a woman like this woman, Lisa, in your careers, where she just thinks she knows better, and then she lost. Look, she could have won too, and then it would have been great. But in this case, she didn't. In any case, it's up to them, but we're just going to try to guide them with what we think is the best. Ultimately, it's always their decision. But those are the kinds of things you want to say too. It's your decision, but let's have the conversation. Have the conversation with the lender. It's a good conversation to have. And we're not just, saying, yeah, lock or don't lock. It's fine. We're going into detail with what will be better for them. Does anyone have that question posed to you as the realtor?
I think people ask sometimes. I think the more knowledgeable people, but like the first time home buyers, I don't, think that they're even aware that that's something that they can do.
Yeah. So we like to have that conversation. We're going to have it in detail. So that's part of what we love. I've been told multiple times, and so has Micah, we're the ones that tell them the most they've heard. They've talked to other people. They're not going into it. I'm all about educating our buyers, and that's kind of how you win them over. When you educate somebody, it really makes them feel like you're the professional. So we wanted to have these conversations with you guys so that you look like the professional, whether you want to have a little bit of this conversation or you're just going to steer them to somebody who is, or point them in the right direction. We don't like the word steering, right? So point them in the right direction for, knowledge. Even if they don't end up using us, we want to give them the knowledge that they need so they feel comfortable. It's a big purchase. If they haven't done it before, even if they haven't done it for a while, when they're a second, time home buyer, they haven't been in the market for a while. So they need all of this education, and that's what we're here to do. So it's a great conversation. I love when I'm hanging up with somebody and they've been very happy with what we've told them, because now they feel like they have a little bit more control of what's going on because they understand it on a deeper level. So that's just the conversation between lock or because you can float down in most cases, lock, because you never know what the rates are going to do. Despite the news is telling us rates are going to be low by 5. Well, they were telling us that 2 years ago, or a year and a half ago, and it didn't happen in 2023. So They said we'll be below 5. Even some of the best forecasters of real estate and mortgages, they were wrong. It didn't happen because there were a lot of things, a lot of factors, like Micah said, that play into this. So let's move on. If nobody has questions for that, let's move on to the next slide, which is Sharon, going to answer your questions, because we do have a lot of great programs. And these programs win us deals. I'll give you a quick example of 2 things on this, and then I'm going to let Micah go over these because he's really good at these as well. This example of a buyer called us for a second look, and they were getting 7.5 with both husband and wife on there. They were first-time home buyers. So Micah and I looked at the deal and we said, all right, let's see what we can do for them. We pulled off one of the buyers because they could qualify with qualifying income only on a product that would have got them down to 6.99%. So we said, look, you can keep your husband on, but we'll qualify you with just your income, because that's going to put you below. They made too much money for some of these first-time programs, but some of them are household income and some of them are qualifying income. So we can even use, like if the buyer gets a bonus, we can ignore the bonus and only qualify them on their salary. Or we can use the bonus from one, not the salary, and the salary of the other if we need a little bit more income. So it can get very, you can get very creative on this. So the lender that they were using was a family member, and he didn't think of any of these things. Okay, so we took the one buyer off. We saved them in their price point. We saved them $150 a month, which was huge for them. The second time around, Micah came up with, hey, we could actually do this other program that we get from one of our investors where they could still do the 5% down that they wanted, but they get 2% back. They can use that 2% for buying down the rate if they want. It's not their money. It's money that the lender is giving them. So it's not like they came out of pocket with that money. And we were able to get them down to 6.5, which saved them $300 a month. Huge. That is just so exciting for me. And for you guys, you look like the hero because you gave them to somebody for a second look, even though they thought they had a family member as somebody that was looking out for them. And we saved them $300 a month. It's gigantic when you see the number of products that we have right here. If you're selling for a banker, like I used to work for Guaranteed Rate, love them and not putting them down. They're a great company. But they can't do some of these products because they don't have them. They can't sell them because they're not a broker. We can sell all of these and they're fabulous. So the second one down there, the 3% down, 2% lender grant back, that's the one that we won that deal over with. $300 a month. You can't often do that. But imagine how happy they were. So go ahead, Micah. You can go over some of the
PA only.
Go ahead.
You have a question. It's for PA only, or she is in Delaware, so she also has that question. Is this
you can use that, and that one, the One Plus program that she's talking about, you can use anywhere in the country, as long as we're licensed there. And then
some of these are,
yeah.
So that one we can do, but some of them are just for specifically Pennsylvania.
Yeah.
So Micah, as you go down these, just go down them quickly. We don't have to get into every single one, but we'll let you know if that's Pennsylvania or anywhere, or Delaware or Jersey.
Okay. So yeah, that one, just so you know, like that one's probably our favorite, only because it doesn't we're not based off of the state's underwriting turn times, so we can close those really quickly, like between 25 and 30 days. And in certain circumstances quicker. I've closed one in 15 days. I don't love to do it, but it's possible. And
that one is, we're in charge of the rate. Some of these ones that are grants, we're not in charge of the rate. The grant sets the rate.
Yeah. And so you can get creative with it if they, with the One Plus program, if they want to save on closing costs. It just all depends on people's goals, of course. Like if they would rather only put 1% down, then they can get the 2% grant pack to cover closing costs and just take the market rate. There's reduced MI. You can also do lender paid MI on that one too, which is sometimes attractive. But this year we've noticed the rates have suffered quite a bit when you do that. So it's better to just pay the mortgage insurance monthly, which is a reduced MI, which is it's like way cheaper than anything else you can get. So that's a
Micah,
really
do you have to be a first-time home buyer for that
no.
product?
So that's the other thing. You don't have to be a first-time home buyer. You just have to make under 91,250 in surrounding counties of Philadelphia, and then in parts of like Lancaster and probably I would think Berks as well. It's like 78,000 is the income limit. But again, usually as you get into those areas, like incomes are a little bit lower. That's why they adjust for that. PHFA, that is state specific. Who was the one in Delaware, or which agent was in Delaware? Stu?
Who?
Machia. Machia,
Okay.
George,
Machia, oh.
some business down there. Yeah.
Yeah, okay. So there are also they have state specific programs as well. So they're like a little bit different, but they're pretty similar. I've closed them before. They're good products. So with
Pennsylvania
PHFA, you can do
yeah.
conventional, which is nice because you don't have people getting upset about having to do an FHA appraisal, which is typically a struggle with that product. 5% down, 3% down options. So you can do 3% or 5% down, and then you can get the 5% KFIT grant back to you. Which, like, if you're putting 3% down, you're getting 2% of that grant going to closing costs, which saves you a ton of money. And you can also get seller. I would like to mention too, with these both KFIT or with both PHFA and the One Plus program, you can still get the 3% seller assist on conventional. So you really could help your buyer get like close with close to nothing. I know for PHFA, they do have like $1,000 minimum for their FHA product. So the borrower has to contribute at least $1,000 of their own money towards the transaction in order to close. But that is a huge.
Andrew just had a question. On the bottom there, Andrew, the minimum credit score is 700 for the One Plus program, and the minimum credit score is 660 for the PHFA, KFIT, and KFlex. KFlex is an expansion of KFIT. KFIT, you have to be a first-time home buyer. KFlex, you can own a home still. You can have owned a home in the past. And the income limit goes up to what KFIT income limits are really good. What are they,
It's
Mike?
like 196. So not many people that are looking for that. Oh, and that's qualifying income too. So that's another perk of that product. The negative to that, and the only reason, and I would like to mention that because it's kind of important, is like the rate is generally a point higher than what it would be for like the KFIT as a first-time home buyer. So it would have to be for a person that's really just closing cost conscious, and maybe they make a good amount of money because their rate's going to be higher, and that just is sometimes a downside because it's quite a bit higher. But it's still an awesome product because they again can close with little to nothing and also make quite a bit of money. So it ends up being a really clutch product for certain people. But yeah, and then so you can also pair it with FHA, which with FHA it's 3.5 down, 5% back. So again, you're getting 1.5 towards closing costs, and you can still get the full 6% assist with FHA. Not to exceed
Mike,
closing costs.
Quick question by Andrew. Is there any product that would go below a 660 credit score, more like 580 to 620? That would be a grant.
Yeah, there's a couple that do that. There's one called the Chenoa Fund, and that is similar. It ends up being a little bit tricky because they charge a certain amount of points for their rate, and then they give you a grant. So it's kind of like a lot of the times doesn't seem to really like do much damage to the closing costs. Um, but they just follow FHA. So as long as it approves with FHA, which is like anything from 580 and up, and 560 if you put 10% down, you are, you can do that program. But that does like it that like the grant they give you back also has a monthly payment associated with it. So it's a very, very specific borrower that would kind of fall into that.
Not
And
the easiest loans, but we have
yeah,
closed. So just
yeah,
if you think you have somebody, those are not a slam dunk. That they're
yeah,
very specific, and they're not quick. So on some of these, like the K-Fit and the K-Flex, as Micah was saying, we have to be subject to their turn time. So first we have to underwrite the loan, which we can do quickly now. But the appraisal has to be back before we can send it off to these state grants that will then underwrite it. And sometimes their turnaround times can be 4 days. They can be 15 days. They can be 20 days. And they can change that while we're sitting in the queue for that first 4 days. If it tells us it's 4 days, it might have got real busy and all of a sudden it's 10 days. So we always say, give us 60 days to close it. And as soon as we get it back, we'll close early. These are all things that, we don't want to take up your time with all the nuances of all of these programs, but we are very familiar with all of them. And Andrew, I answered that with FHA being the only one because I forgot about the Chenoa Fund. So that's why Micah does a lot of these grants. In the 24 years I've been doing this, I've been fortunate that I was seated in a good spot and I had very little grants. Now they're very popular. The grants help people even when one of the things that somebody that doesn't even need the grant program might want to use it because they might want to do work on the property. And instead of doing a renovation loan, which by the way, we have great renovation loans, they could do this where they could just keep extra money in their pocket. And sometimes that little bit of extra money that they're going to get back, that 5%, means a lot for them to keep that. And then 5% of a $300,000 property is $15,000. That can cover some of the, maybe a new carpet or new floors or new appliances. Something that they would not have been able to otherwise afford. So it's not just for closing cost assistance or things like that. It can also just kind of help them with some repairs that they wanted to do right away. So we'll open this up to questions because getting into the nitty gritty of these will be tricky because there's, we could talk for an hour on the One Plus program. It has so many great features, but we don't want to hold you up with all those. But call us individually. I'm happy to go over all of these things with you. But those are the things. Chenoa we didn't put up here. It's used very few and far between. And then Micah, isn't there a $10,000 grant in Philadelphia as well?
yes, yeah. That so just so everyone's aware too, because I find a lot of buyers ask about this that are looking in Philadelphia and they don't know this. Which would be helpful for you guys too, to just educate your people is like, you can't use that if you're already under contract. So you have to get approved for that grant prior to getting an agreement of sale signed. So just keep that in mind when people start to talk about that is like, if they're interested, get them started on that sooner rather than later, because you won't be able to get it if you're already under contract. So that's a huge stipulation that people aren't aware of a lot of times. So
but it's a great grant to get $10,000
it
back.
really is because
fabulous.
it's very low maintenance. Like it's not like PHFA where we have to get it underwritten by them. And if they can get it, I mean, it's huge. So I would.
And then Micah, we did
that.
We did one recently, right, in Delaware County where they got some $5,000 grant for something as well. Do you remember that one? That was I'm trying to think of its name. So there are sometimes county grants that we can look at too, or also employer grants that can go along with some of this stuff. You may have a buyer come to you and say, hey, we get this, just call us and we can look into it from our side to make sure that it can be coupled with certain certain deals. So
Mhm.
I think the overall thing that you want to know is we have these grant programs. Talk to us. I'll tell you this, we're putting people in there that didn't even know they existed. So we're definitely looking at these every time we talk to one of your clients. We're seeing if this is something that would help them out. We're not just calling and someone, I have a lot of people call over the last, several years and say, my father said, I want to go FHA. What about an FHA deal? Once I see what they're better for, I steered him away from FHA. And once I showed him why, he was like, why would my father tell you that? I said, look, your father was doing a good service for you. He hasn't been in the mortgage business. So the mortgage business changes a lot. Years ago, FHA was great for first-time home buyers. Now there's so many better products because conventionally Fannie and Freddie jumped in that arena and they said, look, we can do 3% downs and 5% downs, and the mortgage insurance is cheaper and it's just a better deal. And so we're going to look for the best deal for your client, and that's what you want. You want somebody looking at this that has been doing it for a long time, that can find these little things that other lenders didn't find. That one that we won over on that second look was so rewarding for Micah and I to save somebody $300 just because they had a conversation with a lender that knew about these different options for them. And that's huge. And so if, that's what you want. And even if they don't come with us, sometimes you're going to lose a deal because they're going to go back to their own lender and they're going to say, can you do this? And then they're like, oh yeah, I can do that. Well, in my opinion, do you want to stay with the lender that didn't tell you that?
Okay. I think she might have cut out. Any questions from anyone on this kind of stuff that maybe is
Hey,
maybe I should look at?
yeah. Hi, Micah.
Hi.
I stepped away for a second. Did someone answer the question about the closing cost money coming from gifts?
No,
That's a good question. Okay.
that is a good question. So gifts are pretty simple, like with FHA. So it depends what product it's for. So there are stipulations as to who can give a gift, but they've really broadened that like horizon on who can give a gift. Like you basically can get it from anyone that you know closely as either a friend or someone that's like related to you, stuff like that, which are typically the people that give gifts in the first place. FHA is a little bit different. They have like different restrictions on who can give a gift, but as long as the biggest thing with gifts is honestly to tackle it ahead of time, because we can make it work probably like with the buyer no matter what the situation is, but it just has to be a conversation that's had ahead of time, because we never like a gift to surprise us because it can change desktop underwriter findings. So we like to just be careful with that, because especially if a deal is tight or they have low credit, if you add a gift into the mix without us knowing, like it can be like it can kind of cause problems. The one thing with FHA is like any gift donor that gives an FHA gift has to provide like their bank statements, and that can be an uncomfortable conversation if everyone's not like, kind of aware of that ahead of time. But gifts are great. They're pretty easy to work with, especially on conventional deals. So that's does that kind of answer your question, or do you have any other questions?
Yeah, no, that pretty much answers my question. And it's probably not really versus the state. I guess it's just the lending rules, regulations, or whatever. So
Yeah.
I see
I think
George.
there was one other question too. Yeah, go ahead.
I was just going to say, George had a question about 100% loans, the USDA 100% loans and being state specific.
Doing USDA 100% loans and not
But
state specific. Oh,
yeah,
no, USDAs you can do anywhere. It just has to be in the right areas, as I'm sure he knows. So like it has to be in rural areas, and it's not state specific. It's a government loan, so they go everywhere, anywhere that's a rural area of any state usually.
income changes, right, from area to area. Is that right,
What's that?
Micah?
What was that?
Qualifying income would change from area. I
Yeah,
don't know if you got, I'm having trouble
that's
with
the other
my
thing
internet.
is like with all these products, just keep in mind, like depending on where your buyer's looking, the more like rural the area, usually the lower the income limit. So that's just something to be aware of as well, is like there are limits. I don't know that USDA does change based on area though. Like now that I'm thinking about that, but I can definitely double check that. You know what? Actually, I know it does because there's a chart
It
online.
does.
We don't do those a ton just because we don't like have a lot of people that need those or ask for those, but we have done them. I did one out. We did one out in Pittsburgh one time. So it's like few and far between, but certainly a good product if you have buyers that are looking for that.
We have we have a little clip that we wanted to show you guys, and it kind of based on if no one else has any more questions about this, so we're happy to continue to talk about that. But we have a little clip from one of the forecasters of real estate, and go through in a good time to sell, even though you may have an interest rate of 3%. There's always a good reason maybe to sell.
Okay.
So Micah, can you
Yeah, I'm gonna do that real quick. Share my screen.
Make sure you click on share sound if it's a movie clip of some
Oh,
sort.
okay.
Does
it
share, prompt on the bottom, it says share sound.
Oh, good, nice. Tech Wizard. Okay. All right, here we go. Can you see that, guys?
Yep.
Can you see that, guys?
Yes, we can.
Okay, cool. And this is Barry Habib. He kind of like is who a lot of mortgage people look to kind of guide them on their day-to-day as far as like tracking the mortgage-backed securities. He's also like been known to predict rates. In this, he kind of talks about debt consolidation for purchase. So this is a huge like kind of value add as far as like when you're talking to sellers, because a lot of people have like there's some statistics. Oh, one thing I wanted to share about first-time home buyers before we go on is that makes up 50% of the market right now, is first-time home buyers. So like these products and this knowledge that you guys now kind of have like a more in depth about like these products is going to be huge, because like that's half of who we're dealing with on a daily basis, who are buying homes and who are motivated to buy homes. So like that statistic to me is always kind of like staggering. Last year was 40%. So it's increasing because a lot of people are seeing the values that we were talked about, like from rent to own. And so like knowing this stuff is really helpful. The other thing, the reason this kind of ties into that is because there's also another statistic that the average consumer has $92,000. I think it's the house. It might be household, but basically each household has $92,000 worth of consumer debt. That means like I don't even think that includes student loans. That's just credit cards and car payments. And so like they're paying like super high interest rates on those. And Barry kind of talks about how the fact that we're at 6.75 versus when they bought originally, it was 3%. The way you can kind of make that work for them is to kind of get into their debt consolidation and see like if if they were to sell and purchase a new house, what would their new payment be if they paid off all their consumer debt at 31% interest, for example, for some credit cards, or 25 to 31%. So it's a really good video. So I'll let him take it from here. But let me know if you guys can't hear this.
On the purchase side, same strategy. Okay, my customer's got a 3% rate. They don't want to move because it's 6 3/4. So that creates no inventory, no movement. But the realtor needs your help. They don't know how to do this. Show them. Okay, they bought their home 6 years ago for $500,000, $400,000 loan. They refinanced to a low rate 2 years ago for 3%. So now they owe 343. Their home's 695. But they really need the space. They had a kid, they had 2 kids, they need the room, they want the location, they want this stuff. So what do? I say, well, if I sold the home, minus the debt, minus the cost, I'd have $317,000. I'm going to use that to put down on the new home, plus closing costs. Closing costs, let's say, is $12,000. I'm going to take the $305,000, use it as a down payment on my dream home of $850, so my kids have their own room. Well, that means you need a 545 mortgage. A 545 mortgage at 6 3/4% is a lot more expensive than the 3% mortgage on $400,000 that they originally took out. So they say, well, it's cost me too much. It's $2,500 a month. I don't want to give up my 3% rate because that's like a badge I have. Oh, look at how smart I am. But they do have debt. So what do? When you look at their debt, you say, hey, don't put all your money down in the new house. Put less money down. Take out a higher mortgage. Wipe out your debt. And now it only costs you $280 to buy this home. I don't know if you listened to Eric Bible's podcast that he did with Tim Brahim a couple of weeks ago. The guy is crushing it. He's writing like 5, 10.
Okay. That's kind of the piece. It's just like talking about, how people have debt. They can't avoid it, no matter how hard people try. And that's just a good thing to be aware of when you're wanting to have these conversations with people. Because, it can pull people out of wanting to stick with this low interest rate, and which is the biggest problem we have right now in our industry is the lack of inventory. So the more we can have these conversations and educate people, the better we do as a market. And so I think that's really important to kind of dig into these numbers. And if you need help with that, we can certainly assist, in kind of determining what are your clients' monthly obligations as far as the debt they have. Maybe that's not, their best debt, which is a mortgage, and how can we kind of help them to realize that paying off all that stuff with the equity they have and getting into their dream home can be, isn't as much of a leap as they think. I think that's the biggest thing is kind of teaching people that it's not that big of a leap. And I think it'll go a long way in creating some inventory and generating, potential sellers and stuff like that. So, and that's obviously a conversation we aid with because we'll see when we pull credit, their monthly obligations and all that stuff. So these are things we're thinking about as we are talking to clients and stuff like that, because it's the debt problem maybe not even problem, but the fact that people have a lot of debt is and they have homes is a huge tool to them in kind of consolidating that debt and still getting what they want.
Yeah, and let me just jump in there for a second. So some people say, well, I don't want to pay my car off with a 30-year mortgage, but you can take now loans are so higher that they have credit card debt. I don't want to keep this card. I don't want to start my credit card debt for 30 years. One, if you're paying home credit card, you're going to be paying it for 30 years anyway. But we show them how they can pay it off in a short time. So I did it myself. So I didn't have any more write-offs. My kids are grown. So when rates were really low, I refinanced myself and I bought an RV. I paid off my RV loan with my home with the house loan, but I didn't want to carry that for a 10-year mortgage. But I didn't want to carry that for so long. I wanted to pay it off in 2 years. But now, instead of paying 6% on this RV loan, I was paying 2.625 at the time with which a really good rate. And I paid it off just by making a principal payment. So we paid off, a $70,000 debt in 2 years with just paying extra principal. But now I was only paying interest at 2.625. The same thing, but they're doing a 24% credit card, and they have made $5,000 or $10,000 on it. We'll show them how they can make an extra principal payment, and now they're not paying interest on that for so long, for 30 years. So you're just using it as a leverage tool, and it really starts to click for people. Even a car, you car payment, but your mortgage debt never is off the car loan because it's involved with your mortgage. But you're not going to pay interest on it because you're going to pay a principal as if you're paying a car loan to that. So you can still have a $600, $800 car payment. You're still going to pay it off in 4 years, but now you're paying much less interest on it if we can beat the rate on especially credit cards. And don't get a rate off for credit card a month, but you're certainly going to get a rate off when you're doing it.
Diane, your audio is way off.
Yeah.
Terrible.
Yeah.
Sorry, I don't know why I'm losing it.
And we are actually up against
Micah,
the
you
top
can
of the
take over.
hour. Maybe Micah, throw it out for some last few
Yep.
questions before we wrap things up.
Yeah.
This has been super, I don't know, insightful, helpful for me. I hope it was for everyone on the line today. This is great. And I saw a few people had to drop. Any other questions? Chandra, you raised your hand?
Yeah, I was just wondering, for self-employed people, do you have any, you said you get creative with the other programs. Is there ways to get creative with self-employed people? Like as
Yeah,
far
so
as
like
adding things back in the returns and all that kind of stuff.
Oh yeah. So like anything that can be added back, like they make it, I think there's a lot of talk about self-employed being super hard. It's not really, like, as long as you know what you're looking for and stuff. Like as far as like just like the add backs you're talking about, like not everybody knows what those are and stuff. Like basically like depreciation, my business miles, stuff like that can all be added back. There are cases though where people just they just write off everything they possibly can, and a lot of it doesn't fall under depreciation or some of the other add backs, which those ones, you just can't help. But what I always like offer to people that maybe aren't ready yet is, like, before you file your taxes, just have me take a look at it and I'll help you determine whether or not, or how much you can afford based on how much you are claiming / how much you're writing off. So that is one way we get creative to try and help people that maybe aren't ready. And then but yeah, like, we certainly do a pretty in-depth calculation of their income. You're still Skippy.
Yeah, and that's the benefit this time of year. We help them do it.
Yeah. So that's a good thing to like make your
Exactly.
people aware of. Everybody knows they're self-employed borrowers in their pipeline. So if you want to extend that to them, that if you want to have us take a look at their tax returns and make sure before they file, if they're looking to leverage in the next year for like a home, it's definitely like important for them to get an idea of what they'll be able to afford based on how much they're claiming.
Thank you.
Yeah.
Just one last question. What number for jumbo mortgages do you start at?
It's 766,550.
Wow, 766. Okay.
Yeah, like I barely deal
Yeah.
with jumbo anymore because of how high they've gotten.
Right.
And
are there
what's that?
Are their rates a little lower? I know at one time the rates were a little lower than just regular conventional.
Yeah, you know what? It's really, so like the interesting thing about the jumbo market is it's very appetite driven. So a lot of times it's like if certain investors, like big banks are typically who do jumbo, or small credit unions, it depends if they want the loans or not. Like if their books are like stacked with a lot of mortgage product, they'll probably start to increase them so they get less volume. And then if they want more debt on their balance, then they'll lower the rates in order to get us to lock with them. So it kind of depends, but typically jumbo runs a little higher, but sometimes it is lower. Right now it's about, because they don't move as fast either with like rates as conventional or FHA, because they're like minute by minute kind of, versus like jumbo is not going to be like that. So it's kind of dependent. But right now they're about the same, honestly, as conventional. But there's a lot more stipulations with jumbo. So anytime we can get like people to use the conventional product, we try to do that. But obviously not everybody wants, some people want homes that are $1 million plus. So yeah.
All right. Micah, Diane, thank you.
Yeah. Thank you for having us, guys.
This is awesome. I'm going to stop recording here. We're going to publish this, and we just can't thank you enough for starting our Wednesday off. Happy Valentine's Day, everybody.
Happy
Yeah.
Valentine's Day,
Happy
everyone.
Valentine's Day.